The U.S. economy remains propped up by the stock market's strength, but economists warn that cracks in the labor market could quickly derail the fragile balance. While the S&P 500 is up more than 16% year to date and the Nasdaq nearly 22%, lifting investor sentiment and consumer spending among wealthier Americans, recent data from the University of Michigan's Consumer Sentiment Index shows overall optimism fading. The index dropped 6% in November and sits 30% lower than a year ago, with most households citing concerns about the prolonged federal government shutdown and rising economic uncertainty. In stark contrast, affluent Americans with significant stock holdings reported an 11% rise in confidence, buoyed by portfolio gains and rising home values. Economists say this underscores a K-shaped economy, one where the wealthy thrive on asset growth while working, and middle-class families struggle with inflation and stagnant wages. The top end of the market is thriving, but traditional sectors like retail and manufacturing are slowing, said Joe Brusuelas of RSM US LLP. The AI boom and rising equity valuations are masking deep structural stress for lower-income households. The resilience of the stock market has so far cushioned spending in luxury and high-end services, helped by strong home equity and low mortgage rates among upper-income households. Jeffrey Roach of LPL Financial noted that rising home equity and fiscal optimism surrounding President Trump's Big Beautiful Bill have reinforced expectations of corporate profit growth, keeping markets buoyant. Yet, the sustainability of this strength depends on whether the labor market holds up. Recent surveys point to slower hiring and reduced work hours, especially among small businesses. Wage growth is cooling, and with the government shutdown halting official job reports, analysts fear the slowdown could already be taking hold. The stock market is acting as if the top of the K can carry the rest of the economy indefinitely, said Luke Tilley of M&T Bank. That's not sustainable. Once job growth turns negative, markets follow. For now, the U.S. economy remains resilient but fragile, powered by investor wealth and confidence rather than broad-based income gains. Economists warn that without a stable labor market, even affluent consumers may soon curb spending, risking both consumer confidence and market momentum. As Brusuelas summed up, the wealth effect is keeping things afloat, but it's not a substitute for real economic strength. If the labor market cracks, the illusion of stability could disappear overnight.